ओके, तो रौनक, तुम्हारे मन में किसी कैश फ्लो को लेके कोई डाउट है कि क्या ये कैश फ्लो मैम ऑपरेटिंग होगा कि इन्वेस्टिंग होगा, और डू यू वांट मी टू गिव यू अ जेनेरिक आंसर?
Just a generic answer, like suppose like there was in operating activities there is increase in accounts payables. So I could not comprehend that in which part would that fall.
Okay, Ronit. So generally, Ronit, accounts payables is a term that we use whenever we have a contractual obligation to pay a supplier. ठीक है, ये term हम लोग तभी use करते हैं. Now, naturally, जब हमारे business का operations चल रहा है, when we are actually in the production of our goods and services, it is only then that we would be purchasing anything from suppliers for the business, right? So this becomes an operating expense because it is directly related to your operations. Any purchases of raw material or equipment for running your factory that you're making. Now, if you purchase a heavy machinery, okay, suppose something that will last 10 years, or you want to set up another factory, bhai, wo bhi to ek purchase hai for your operations only, right? Eventually you will run your operations on that. But because the nature of the asset being created is a fixed asset or a long term asset, तो हम उसको investment मानते हैं as a strategy. Investment, as the name suggests, is something that you put in today for returns in the future, not immediately. जैसे operations में तो हमने अभी raw material लिया और अभी उसमें हमने machine जो भी grease और ये वो overhead लगा के labor लगा के उसका अभी product बना दिया, right? But when you are investing in fixed assets, they are long term, they are strategic in nature, and you are supposed to generate returns from them over a period which is longer than 1 year. तो सिर्फ ये distinction है. जब भी हम करंट एसेट्स के लिए पैसा खर्चा करते हैं, जैसे फॉर एग्जांपल अपना इन्वेंट्री बढ़ाने के लिए पैसा खर्चा कर रहे हैं, या हमने सेल ऑन क्रेडिट कर दिया तो डेटर्स क्रिएट हो गए, या रिसीवेबल्स क्रिएट हो गए, या ऑफ कोर्स नेचुरल कैश या बैंक बैलेंस है, तो उन सबको हम अपने ऑपरेशन से ही लिंक करते हैं, बिकॉज इट इज ओनली बिकॉज ऑफ माय ऑपरेशंस देन दिस काइंड ऑफ ट्रांजैक्शन इज हैपनिंग. ओके, कैश तो दोनों में फ्लो हो रहा है बाहर, इन्वेस्टिंग में भी बाहर जा रहा है, और जब आप ऑपरेशंस कर रहे हैं तब भी आप खर्चे उठा रहे हैं. बट क्या खर्चा है, दैट इज व्हाट इज रिक्वायर्ड इन रनिंग योर ऑपरेशंस, एंड व्हाट इज अ लॉन्ग टर्म इन्वेस्टमेंट is the distinction between operating activities and your investment activities. Okay, Ronit?
Okay, thank you.
तो अगर अभी सपोज अगर हम, अच्छा तीसरा चीज, अगर हम लोन लेते हैं तो लोन naturally if I am taking, that is also being done either to buy an asset or to run my business, but loan becomes a financing cash flow because ये हम finance कर रहे हैं अपने assets को through loans. So equity, debt, loans, debentures, preference shares, ये सब financing के instruments हैं. These are all instruments of financing, and hence anything to do with loans, interest payable, dividend payable, or coming out with the shares issue, coming out with debentures, paying back debentures, etc., will all be clubbed as financing activities. So all three activities basically can lead to cash inflows also and can lead to cash outflows. Just for better management, just for better understanding, we split them into these three heads so that we are very clear कि भाई जो हमारा मेन काम है, जो हमारे operations हैं, उनके ये कैश फ्लोज हैं, जो हमारा लॉन्ग टर्म स्ट्रेटेजिक डिसीजन मेकिंग है जिसमें हम एसेट खरीद रहे हैं, उसमें हमारे ये कैश फ्लोज हैं, एंड हाउ आर वी फाइनेंसिंग आवर बिजनेस, व्हाट आर द लायबिलिटीज दैट वी आर क्रिएटिंग फॉर आवरसेल्व्स, लॉन्ग टर्म लायबिलिटीज, उसको हम फाइनेंसिंग में देखते हैं. तो इट इज जस्ट फॉर आवर it is just for simplifying these cash flows and for better management of cash flows that we divide them into these three categories. Okay, Ronit?
Okay, I got it. Thanks.
Is it clear now? Do you have the reply to your question?
It's clear. It's clear.
Okay, clear. Great. And Ronit, if you see, I have also shared that Msl405 material with you. Read that. उसमें और डिटेल में दिया हुआ है about cash flow statements and everything. So उससे तुमको और understanding होगी. Plus, if you have any other doubts or questions after that, then you can definitely come back to the class, or you can ask me or ask Harshita or Samriddhi, anyone. Okay?
Okay.
Okay. Thanks, Ronit. Anyone else who has any doubts or any questions? Okay. Now, typically the next chapter would be to understand cash budgets and how to prepare cash budgets for startups, because you know that for a startup, cash is the most vulnerable aspect. Okay. And as we saw in the previous example, even when a company can be making profit, still it may be short of cash and can face very dire situations. But before that, I wanted to share a case study with all of you, because all of you have been divided into groups and you have to make presentations on first also about your startups, which you can use as a base, as a framework for your work, okay, for your presentation. And it basically encapsulates whatever we have done so far in one case. And we have done a lot of numericals also, but it will give us some more perspectives to look at the same thing. Okay, so I think it will be important for you, and I will upload it also right away so that you know you have it. And when you're working in your groups also, you can use this as a base. Harshita, I hope you've started the recording and all.
Yes, ma'am, already.
Okay, so now I'm going to share my screen. Okay, it seems I had already uploaded it. Harshita, is this visible?
Yes, ma'am, it is.
Okay, so as I was telling you, students, we have already done all of this in bits and pieces through different chapters that we have done so far, but this is one comprehensive case study that gives everything together. Okay, so we are looking at a startup called the Hand Pilot Company. Of course, students, since I'm looking at the document, I would not be able to see your raised hands or messages. So Harshita, just keep an eye out in case someone has a question, just let me know. Otherwise, all of you, please feel free to just unmute yourself and stop me wherever you have any doubt. Okay?
Okay,
Fine. So the Hand Pilot Company, formed at the end of 2015, is in its startup stage. The venture developed and produces a handheld electronic device called the Hand Pilot that controls kitchen appliances. That is, it adjusts settings as well as turns them on and off from remote distances. Now, all of you know, with the advent of IoT, we already have some apps which help you do that from your cell phone, but this is talking about a completely standalone device. Hand Pilot sales are expected to be $1 million in 2016, which is about to come to a close. Rapid sales growth is expected over the next 5 years, and Hand Pilot wishes to prepare 5 years of sales forecasts for potential investors. How should the forecast be made? Now, as an emerging venture, Hand Pilot doesn't have the luxury of extrapolating from past sales data. In these circumstances, a top-down, market-driven approach is useful. First, Hand Pilot estimates the next 5 years' overall market demands. Contracted market research estimates market demand of 20 million in 2017. It also suggests that the most likely scenario is a subsequent 4-year market growth rate of 50%, which will reach 101 million by 2021. The Hand Pilot has decided to give this scenario a 40% weight and assess 30% weights on 40% and 60% growth rates. So this is the kind of scenario that they are developing about the industry as such, the probability and the sales growth associated with each scenario. So we have optimistic forecast, the probability of which is 30%, and the sales growth associated with it is 60%, which gives us a components to sum of 18%. Then the most likely forecast has a probability of 40% and a sales growth of 50%, so which gives us a total of 20%. And a pessimistic forecast of 30% probability, which has a 40% sales growth rate, is giving us a final growth rate of 12%. So when we add all of this, then we get the expected value of 50%. Okay. Now, Hand Pilot has several competitors that have completed test marketing and are set to sell their own versions of kitchen appliance controllers. there are 3 potential rivals as far as Handpilot knows, which have not yet decided to design or market a similar device. So they are in the same sector, but they are not yet ready with a device. But there are 3 people who have already finished their test marketing and they are also ready with their product. Handpilot's management is confident that successful business plan execution will yield a 25% market share throughout the 5-year planning horizon. With the 2017 market size at 20 million, this implies initial sales of 5 million for Handpilot. So figure 9.3 illustrates the Handpilot's hockey stick sales pattern, typical for a new and successful high growth venture. At a 50% growth rate, Handpilot sales will reach 25 million in 2021. Figure 9.3 also displays a trajectory for 60% and 40% growth rates. 60% growth leads to Handpilot sales of 32 million in 2021 and 40% sales growth leads to 19.21 million. Now Handpilot needs to validate its sales forecast by contacting existing and potential customers. I've been telling you all this while that it is so important to be in touch with your existing and potential customers to actually know whether your product is ready to go to market, what is going to be the potential sales, what is the price that they are willing to pay, and so on. Because there were initial orders and sales leads in 2016, these customers and leads can provide critical information for the successful execution of Handpilot's business plan. Okay. Now here you can see this figure. You must remember this from the previous case that we did. It is a hockey stick pattern which basically bifurcates into the different growth scenarios and what would be the resultant revenues based on this. Finally, Handpilot should ensure that projections incorporate realistic expectations about price trends, if any, due to market competition and inflation. For planning purposes, Handpilot has adopted the 50% growth rate scenario. So if 50% is what they are adopting, then year-on-year growth will look like this. In 2017, they started with 5 million. 2018, with the 50% growth rate, it will become 7.5 million. 2019, it will become 11.25 million. 2020, it will become 16.88 million. And 2021, it will become 25.31 million. Of no small consequence, the $5 million projected for 2017 reflects a 400% increase. As you can see, 2016, it was just 1 million. And from there, it has jumped to 5 million. So this shows that Handpilot has moved from its survival phase and entered its rapid growth phase. So that is an exponential jump. And then there's a high growth rate that is associated. Okay. Before we move on, a caveat is in order. It is natural and in most cases even desirable for entrepreneurs to exhibit extreme optimism about sales and expense forecast. VCs and other seasoned investors know that forecasting sales usually gets easier as firm matures. Figure 9.4 illustrates this relationship between life cycle stage and forecasting accuracy with appropriate financing for each stage. Difficulty in accurately forecasting and rationalizing financial projections has traditionally been a sign that private equity fundraising is more appropriate than public equity fundraising. Developing and rationalizing forecasts for Samsung company would be relatively straightforward. In contrast, Handpilot's forecasts call for an immediate 400% growth followed by 4 years of 50% growth. These forecasts are highly subjective and may involve leaps of faith rather than cold, hard, rational expectations. Okay, so VCs know this, okay, and they also understand that this could be major leaps of faith. So just let's look at this figure first. Naturally, when you are just starting off with your venture, the accuracy of your sales forecast would be very, very low because you don't have any past sales, current sales, any market data at all. As you grow through your life cycle stages, it becomes more easy for you to forecast sales because you are now having some realistic market data and you have customers, you're in touch with them, and so you can kind of understand the demand. Okay, so this is just a chart to tell you about the relationship between life cycle stage and sales forecasting accuracy. Okay. Consequently, we shouldn't be surprised to see Samsung seeking public financing while Hand Pilot negotiates for private equity financing. So if you recall, we had seen Samsung's case where we had past year's data and we were using that to forecast future sales, and there it would be very easy for this company to just go public and get money. But for Hand Pilot, because we don't have any such basis, they would still need to function in private equity markets. One way that venture investors adjust for optimism and forecasting difficulties is by revising an entrepreneur's sales forecast downward and expenses upward. For example, a VC might alter the range of sales growth rates, particularly on the downside, or assign different weights. In the Hand Pilot example, the 40% rate forecast is probably too unrealistically high to be considered pessimistic. I mean, if you're making 40% growth, then that can't be said to be pessimistic. Perhaps 10% is more appropriate. Although the investor may like the 60% growth rate, perhaps this optimistic scenario deserves only a 20% weight rather than 30%. With the weight shifted over to the pessimistic scenario, increasing it to 40%. So what your VCs can do is they can basically suggest something like this, that instead of giving your optimistic forecast 30% probability, they bring it down to 20%. And instead of giving it to pessimistic forecast of 30%, they bring it up to 40%. And the sales growth rate that they associate with the pessimistic forecast, they may bring it down from 40 to 10%. So now when we do the calculations, the expected sum or value becomes 36% instead of the 50% that the company was projecting. So VCs are known to do all this. The best thing to do would be to use one of the many freely available Excel templates which are there for projecting cash flows, P&L, balance sheet, everything, and keep that spreadsheet template handy, so that if the VC say, okay, what if we revise our expected growth rate to be 36%, what would the financial statements look like then? Then you can immediately just key in the numbers and show them the resultant figures. Okay, so it's always a good idea to maintain that live Excel with you. Thus, the ventures investors' revised projections would be based on a growth rate of 36% rather than 50%. Note that the previous most likely forecast has been relabeled a management forecast. Now they calculate it and say that it's a management forecast, and it now carries the same weight as a pessimistic forecast. So with 36% growth rate, the projections for the next 5 years would be as follows. So from 5, you will move to 6.8 millions. From there, you will move to 9.25 million. From there, you'll move to 12.58, and from there, you'll move to 17.11. So instead of the 25 million that the previous projection was showing, by this revised projection, you will only be making 17.11 million after 5 years. So the result is that the sales are projected to reach only 17 million by 2021 rather than the 25 million Hand Pilot is forecasting, using 50% growth. Furthermore, as the Hand Pilot venture was in its development stage in 2015, one could defend slashing the growth rates even further. If an investor were to believe that only 2 scenarios equally weighted were relevant, then the following might result. Now, suppose you are seeking financing when you are still in the development stage, then your investors may be more critical and they might say, listen, you are still developing, you have not even tested the markets, you have not even offered your product into the market yet. So according to me, there can only be 2 scenarios. A, you sell or you don't. So in case you sell, which is a management forecast with a 50% occurrence, then you can maybe achieve 50% growth rate, and that will come out to be 25%. And in case you're not able to bring your product to market, then you make nothing. So then the sales growth will be 0. Okay. So then the expected value will further come down to 25%. So clearly there are many possible scenario weighing combinations, some of which are valid views of Hand Pilot's possible future. It is important to remember that one of our entrepreneurial finance principles is that new venture financing involves search, negotiation, and privacy. Different beliefs give rise to different scenarios and weights, which lead to different projected growth rates and to different prices paid for the venture securities. The process of new venture fundraising is centered on finding a workable compromise between founder and investor beliefs and the related venture projections and values that enables the venture to pursue its business model or plan. Now, working towards a compromise involves an inherent dilemma. On the one hand, venture investors don't want to curtail the entrepreneur's optimism. Formally adjusting the entrepreneur's forecast downward to reflect more reasonable expectations may be taken as a lack of confidence or even as an insult to the entrepreneur's expertise. And this I have seen happen with a lot of entrepreneurs. Whenever you have potential investors who try and revise their estimates downward, they take it as a personal insult or an assault to their ego. Very few are able to take it well. It can also set up either motivating or dysfunctional. I am going to show you situations depending on the personalities involved. So people get very egoistic here. This is one of the main reasons that many venture investors will work with founders' optimistic scenario business plans without much adjustment for other scenarios and alter their valuation approaches accordingly. तो यहाँ पे तो वो कुछ नहीं कहते हैं, लेकिन जो valuation कर रहे होते हैं उसमें उनको नीचे कर देते हैं. So we will see venture valuations also, but we will see that after doing, I think at least 2-3 more chapters on cash budgets and all, then we'll see how ventures get valued. Okay. Now we come to the sustainable sales growth rates. To increase value, most ventures need to increase their scale. Revenue growth in isolation, however, does not assure increasing value. Incremental sales must lead to incremental overall profits and produce free cash flows. There are several potential impediments to a lockstep relationship between incremental sales and incremental cash flows. First, the incremental sales must be sold at prices that cover all incremental costs, that are capacity and variable cost. This may not be so easy if the venture, like most firms, faces downward sloping demand with lower prices required to sell more units. Second, the revenues from additional unit sales must cover increases in working capital investments, which are inventory and accounts receivables, required to support those incremental sales. So we have to ensure that just by getting more sales does not mean that we are increasing value. We must ensure that incremental sales lead to additional profits or incremental profits, and it gives us free cash flows. And these free cash flows will become the basis of valuation for our ventures. There are many other methods also, but the free cash flow approach to valuation is the most appropriate and popular method. Okay. Only when sales revenue cover all of these costs are there free cash flows that can give rise to an increase in venture value. When a venture requires external funds to support expansion, the venture must consider whether its margins allow it to pay its costs and still provide the type of return demanded by venture investors. Some ventures will conclude that slower growth from internal funding is a better way to go. Others will seek out external capital in a costly but total commitment to rapid growth. A firm's net income or profit after taxes, also referred to as its internally generated funds, can be distributed to owners or reinvested to support growth. The portion retained in the business becomes an increase in retained earnings, and the sustainable sales growth rate is the rate supported without external equity capital through the retention of profit. So we have already done this formula, but let us look at it from a different perspective. If a firm can scale itself up without changing its strategy and margins, the firm can increase its sales at the growth rate of its book value of equity. So sustainable growth rate is nothing but the ending equity minus the beginning equity upon the beginning equity. You can also write this as change in equity upon beginning equity, or delta E upon E beginning, where G is the annual percentage growth rate in equity. Delta E is the change in equity during the year, and E beg is the equity at the beginning of the year. Assuming that the venture does not raise new external equity or retire existing equity, we see that its equity only changes by earnings retention. So the change in equity is nothing but the net income into the retention rate, okay, where RR is the proportion of net income retained in the firm. For early stage ventures, the retention rate will be 100%. In fact, it should be 100%. And in early stage ventures, no dividends should be paid out. More mature firms may use some of their income to fund a dividend, and the retention rate is 1 minus the dividend payout percent. So it can be 1 minus DPO percentage. So dividing both sides of the equation by the beginning equity gives us delta E upon E beginning is equal to net income upon E beginning into RR. And by substituting G in the left side, we get G is equal to net income upon E beginning into RR. So net income upon E beginning is nothing but ROE, which we've already seen and calculated. Okay. So this is the same method that we can use. Okay. For concreteness, let's look at an example over here. Assume that the venture started the year with 10 million in book value of equity. It plans no intermediate equity injections or withdrawals and projects a net income of 2 million for the year. It will pay a $500,000 dividend, which is 25%, at the beginning of the next period and retain 1.5 million, that is 75%. Assuming it will scale up with the same margins, we see that the venture will grow by, so net income is 2 million upon the beginning value of equity, that is 10 million, into 0.75, which is the retention ratio. That gives us 15%. Okay. The venture's maximum sustainable growth rate is at 100% retention, where G max would have been 20%. So naturally, if this 0.75 was 1, then the maximum sustainable growth rate that the venture could have had would have been 20%. Okay. If the firm projects growth in excess of 20%, it must raise external equity capital, have some scaling advantage leading to improved asset efficiency, and have lower incremental variable cost or some other organic change. Okay. So here, of course, you have not done, if you have not done any base course, then you may have a difficulty in remembering this model. This model is called the DuPont 3-point ratio analysis, okay, where ROE is broken down into 3 aspects. One is net profit margin, the other is asset turnover, and the third is equity multiplier. Now this will finally just break down into net income upon beginning equity only, but we are now splitting it into 3 aspects to see that if I want to increase my ROE, then I would need to work well at least in one of these 3 aspects. So here NI is net income, NS is net sales for an accounting time period, usually 1 year. CE is common equity, and TA is total assets. Again, when conducting sustainable growth analysis for a period with no new capital infusions or withdrawals, we want to use beginning of period measures. Assuming that all equity is treated as common equity, that is as converted, if the venture has convertible preferred equities, we can insert equation 9.5 into equation 9.4 as follows. So this then becomes NI upon NS into NS by TA into TA by C beginning. NS cancels, TA cancels, and it will come back to your original equation of NI upon CE into RR. A venture's maximum sustainable growth rate is its return on beginning equity, which decomposes into the product of net profit margin, asset turnover ratio, and the firm's equity multiplier ratio. When the venture retains less than 100% of net income, this maximum sustainable growth rate must be adjusted downwards to the venture's projected sustainable growth rate by multiplying Gmax by the retention ratio. Okay. So let us look at an example on the kind of data that you will be given to calculate this. The game toy company has recently introduced a new home video game. Game toy has a projected sales growth rate of 30% per year. Sales in the first full year of operations were 1.6 million. These sales were supported by an investment in assets of 1 million and produced a net income of $160,000. Equity at the beginning of last year was $800,000. Management intends to retain all profits in the venture. Assuming the components of the ROE model scale remain constant with growth, the sustainable sales growth rate formula for the equation is this. NI is 160,000 upon NS is 1.6 million into NS 1.6 million upon TA, that is 1 million, into TA, that is 1 million, upon the equity, which is 800,000, into 1, which is the retention rate. So when we substitute all of these values, we come to a growth rate of 20%. So if you have current financial data, you can use that also to project a growth rate. Any doubts, any questions so far? Harshita, is there anyone who's put up their hands or?
No, ma'am.
Okay. So game toy can grow its sales at 20% each year as long as profit margins, asset turnovers, and financial leverage ratios remain constant during the increases and all net income or profit is retained. Another way to look at sustainable growth is to separate the firm's operating performance and financial policy. We can recall, okay, so this you will not be able to recall because you have not done the main things, but you should understand that the net profit margin is nothing but net income upon net sales. Asset turnover is nothing but net sales upon total assets. Now, we will be doing a chapter on the ratios which are common to startups, and so we will do this over there again. Now, this ratio, net income upon net sales into net sales upon total assets, actually gives us net income upon total assets, which is also called the return on assets. And this is a measure of operating performance. The product of financial leverage or equity multiplier component and the retention rate reflects the firm's financial policy. So we can also rewrite this equation as operating performance into financial policy, or ROA into FP. To illustrate, we return to the game toy venture. Recall that the equity multiplier was 1.25 using beginning of period equity and retention is 100%. Accordingly, the financial policy factor is 1.25 and the sustainable growth rate is ROA into 1.25 into 1, that is equal to ROA into 1.25. So this shows that sustainable growth varies linearly with the venture's return on assets as long as the financial policy, that is financial leverage and retention of profit decision, remains stable. So figure 9.5 presents a graphic representation of this linear relationship. When game toys ROA is 16%, sustainable growth is 20% or 0.16 into 1.25. The solid line depicts sustainable growth at various ROAs. Growth rates above the line, such as 30% target sales growth rate, are not feasible without operating improvements, changes in financial policy, or external equity capital. Owing to market capture considerations, many early stage ventures will not want to limit growth to the sustainable level. So a lot of entrepreneurs who are not desirous of losing control or ownership would want to limit their growth to a sustainable level where they can use only their own internal funds to fund that growth. Improvements in profit margins and or asset turnovers leading to improved ROA can pave the way for some growth beyond the current sustainable levels. Okay, so this is the graph that shows that your ROA and your growth is a linear combination. Okay, so you have to do a better job at the ROA to actually go through a growth rate which is higher than the sustainable growth rate. For example, we can solve for the ROA operating performance that Game Toy would need in order to achieve 30% sustainable growth. So here, if we just put in the values, we can compute the ROA to be 24%. So to achieve a sustainable growth of 30%, Game Toy would have to improve its return on assets from 16% to 24%, which is a 50% improvement. Yes? Does someone have a question?
Yes, ma'am. Ma'am, could you explain the financial policy part?
Just a second. Ronit, can you please speak up? Your voice is very faint.
Ma'am, could you explain the financial policy part?
Okay. Now, Ronit, basically financial policy indicates how you want to finance your business, whether you want to use more of equity or more of debt and so on. Now, this total assets to the common equity ratio basically tells you how much of your assets are funded by equity, right? Which is your owner's money. Are you okay with that much, Ronit?
Yes, ma'am. Yes, ma'am.
Okay. Now, the third source of finance, which is very, very crucial for a startup, is your own income that you're making. That is your own net profit that you're making. Now, mostly, as I said, startups would always retain 100% of their profit. They will not give it out as dividends. They would want to plow it back into the business to fuel their growth. So if I look at my complete financial policy in terms of the owner's money that is being fueled into the business, because I'm eventually trying to look for returns for my owners or shareholders, then not only am I looking at the beginning component of equity, but I'm also looking at how much of my net income that I made in this year am I plowing back into the business. Okay, so there comes your retained earnings wala portion. So if you remember, we were looking at net income into RR to understand how much is the retained earnings. So your total financial policy would deal with what is your equity multiplier, that is nothing but how much of your total assets are currently being funded by equity, plus how much more equity money are you plowing back into the business. Usko hum bolte hain financial policy. Okay, Ronit?
Okay, ma'am.
Okay. Anything else? Anyone else? सिर्फ एक रौनक ही पढ़ाई कर रहा है ऐसा लग रहा है, बाकी सबके अब तो सब कुछ समझ में आ रहा है या कुछ भी नहीं आ रहा है? Okay. So to achieve a sustainable growth of 30%, Game Toy would have to improve its return on assets from 16% to 24%, which is a 50% improvement. Now, can you do that? Does your management have the strategy to actually improve your return on assets by 50%? Only then can you have a sustainable growth rate of 30%. So basically what this case is telling you is about the background strategy and background decisions that you have to take to be able to reflect those numbers in front of your investors. Typically entrepreneurs keep throwing numbers, but when you ask them how would you ensure this, then they have no idea because they have not done this background work. And this is what entrepreneurial finance is, that you are able to understand how you are saying that I will move at 30% or 20% growth. Debt is notoriously scarce and most likely already would have been used to the extent possible. Now, Ronit, you know that in a startup, debt is almost not available only because neither do they have any sales, nor do they have any assets to put as collateral. So typically equity and retained earnings are all they have to finance their business. Okay. If Game Toy had been funding part of its assets with debt, the sustainable growth rate of 20% already incorporates the benefit of continuing the debt strategy as a percentage of assets. To enable additional growth, Game Toy must borrow even more per dollar of assets than it currently borrows. As Game Toy probably has exhausted all avenues for improving operating efficiency and expanding debt, external equity capital markets become the only viable path to realizing its growth ambitions. Okay. So this is just more perspective on your growth rates. Then we come to estimating additional financing needed to support growth, which we have already done through numericals, but let us look at it in more detail. While it is useful to understand a new venture's growth prospects in the absence of new external equity, projected growth rates in the business plan almost invariably exceed the sustainable rate even after efficiency improvements, maximum retention, and exploitation of all debt avenues. Predicting the magnitude and timing of the shortfall becomes an important process for the rapidly growing venture. So we come to another figure, figure 9.6, which shows the major funding sources available to ventures that have successfully reached their survival or rapid growth life cycle stages. Business operations become an increasingly important source for growth funding. In addition to producing revenues, growth ventures need to earn and retain profits. It is important for rapidly growing ventures to employ supplier trade credit to help fund the increasing volume of goods and services needed for expansion. Recall that this type of financing typically results in short-term accounts payables. Employees and the government provide spontaneous short-term financing. Wages payable financing arises because employees are paid only after a delay. That is, you never pay employees immediately. You always pay them after a week or a month between the labor with the booking of the associated expense and the payroll check for that labor. The government provides short-term financing in the form of taxes payable because actual tax payments typically lag the recognition of the amount owed to the government, that is the tax expense. So let us look at this figure and here. So in the survival stage, you get what is called the Series A funding or first round financing. Major sources of these are your own business operations, the VCs, your suppliers and your customers, government assistance programs, and commercial banks. And in the rapid growth stage, where you get Series B funding, Series B, C, D, E, all these different tranches, also called second round financing, mezzanine financing, or liquidity stage financing. Again, the major sources of players are business operations, suppliers and customers, commercial banks, and naturally investment bankers now also start circling the company because, yes, Ronit?
What do you mean by mezzanine financing?
Mezzanine financing, Ronit, if you recall in the earlier slides we had done, basically this is a kind of a convertible debt that is given for ventures for capital expansion, okay, capacity expansion. Because in the rapid growth stage, your market is growing so rapidly that you need funds just to expand your fixed assets or your capacity. So mezzanine is a convertible debt kind of finance that is given purely for the reason of capacity expansion. Okay, Ronit. And this is the first time that debt is actually coming onto the balance sheet because आप asset create कर रहे हैं. So naturally the banks can use that as a collateral, and so they are happy to give you debt, and they are much more confident because you have already entered into your rapid growth stage where you're growing at 50% growth rates, which are phenomenal growth rates for any market. And so this is the first time that the venture actually gets proper debt in the form of mezzanine financing. Okay, Ronit?
Okay.
Okay, very good. Anything else? Anyone? Okay. Now, yeah, this we have done. Now, in the event that a growing venture's investment in assets is not financed by profits from its business operations, plus spontaneous financing from suppliers, employees, and the government, additional funds will be needed. These additional funds will need to come from external parties, including VCs, venture investors that provide mezzanine financing, government assistance programs, commercial banks, and investment banks. It is important for the entrepreneurial team to estimate any shortfall in financing and negotiate for additional financing well in advance. We will now turn to a review of the back of the envelope method for estimating the amount of additional financing needed to support revenue growth. So we've already done this, but see students, when you make your projections, when you present your startup, if you're saying that I would need $2 million in financing, then how have you come to that figure? What is the money that your business is already generating? Okay, so you will need to show us this business basic additional funds needed equation. Now, financial capital needed is the additional funding required to support a firm's projected growth. Some of this funding will be covered by trade credit and other current liabilities that increase spontaneously with sales. Spontaneously generated funds are increases in accounts payables and accruals, that is wages and taxes, that accompany sales increases. For example, when sales increase, credit purchases from suppliers should also increase, leading to lockstep increases in accounts payables. If the venture is profitable and scaling up without margin changes, its increase in profits when retained help meet a firm's financial capital needed. Now, the additional funds needed, or AFN, is the gap remaining between the FCN and the capital funded by spontaneously generated funds and retained earnings. So from your business, you are getting these spontaneously generated liabilities which are indirectly funding you, plus you have your own internal retained earnings which are funding you. But when you have a higher requirement of an increase in assets, then the additional funding needed is required increase in assets minus spontaneously generated funds minus increase in retained earnings. So if we split this into an equation form, it will come out to be the total assets upon the initial net sales into the change in sales that you're looking at, that is the growth, minus all the accrued payables plus all the accrued liabilities upon the original sales into the growth in sales that you're looking at, minus the new sales growth into the net income upon net sales, which is basically the profit margin, into the retention ratio. Okay, so where TA is the total assets, NS is the total net sales, this is delta. Delta NS is the change in net sales expected between current year and next year. AP is the accounts payable, AL is the accrued liabilities, and NI is the net income. RR is the retention rate as previously defined, and the subscript 0 and 1 represent the current year and forecast for next year respectively. So we can now see the AFN into an equation form as well. Notice the similarity to the sustainable sales growth rate equation. First, to determine the required increase in assets, we need to establish the percentage relationship between total assets and net sales. Instead of using the asset turnover ratio, which was net sales upon total assets, we take the inverse to get a percentage. So iska inverse is total assets upon net sales. That is also called asset intensity. This percentage then is multiplied by the change in net sales to obtain the required increase in assets, that is the FCN. The change in net sales reflects the projected growth in sales. The third term, that is the increase in retained earnings, is the projected internally generated funds. That is next year's sales times the prevailing net profit margin multiplied by the retention rate. However, the sustainable growth rate and the AFN equations differ. The AFN recognizes spontaneously generated funds, the second term in the equation, and does not assume that financial policy or leverage is proportional, as is the case with the sustainable growth calculation. So यहाँ पे अलग है. The AFN focuses on determining the total funding gap, allowing the management to decide whether debt or equity will bridge that gap. So let us look at an example. Recall that Game Toys last year sales were 1.6 million and they were supported by 1 million investment in assets. The sales produced a net income of $160,000. We will calculate the AFN assuming Game Toy contemporaneously had current assets of $520,000, fixed assets of $480,000, accounts payables of $48,000, and accrued liabilities of $32,000. At a 30% growth rate, the next year's sales will reach 2.08 million, which is nothing but 1.6 million into 1.3, a change of $480,000. So now the equation becomes your original sales. So how much is that? 1 million, that is your initial investment in assets, upon the original sales of 1.6 million, into the net change in sales that we are looking at, which is 480,000, minus 80,000, which is your accrued payables plus accrued liabilities, upon the original sales, into the change in sales that you're looking at, minus the new sales or the net sales that you're projecting, into the net income upon the original sales, which is your net profit margin, into 1, which is your retention ratio. Okay, so this then becomes, if you substitute and calculate the values, your AFN becomes $68,000. Okay, so Game Toy will need $300,000 in additional financial capital to acquire the assets needed to achieve the projected 30% growth in sales. The company projects 24,000 to come from spontaneously generated funds, that is liabilities to suppliers, employees in the government, and 2.08 million from retained earnings. The remaining AFN of 68,000 must be raised from new external finances, that is from debt or equity. Okay, so this panel A in figure 9.7 illustrates the $300,000 increase in Game Toys assets necessary to support next year's 30% growth. Notice that the percentage change in assets is the same as the percentage change in sales, because the AFN model assumes that the past relationship between assets and sales remains stable, scaling with no margin change. Panel B depicts how the 300,000 in additional assets will be financed. So you can see here, in the first panel, we see the increase in assets that would be needed to support a 30% increase in sales. So this would be a $300,000 sale. So now naturally, when you need $300,000, here is a component on how you will get it. So you'll get 2.08 million by increase in retained earnings. You'll get $24,000 through spontaneous funding, and you'll get the remaining $68,000, which is your additional funds needed. For this, you'll have to raise fresh equity or debt. Okay, so I expect that you are also able to create a panel like this for your startup and to present it to us. Any doubts, any questions so far? Have a sip of water. Okay. As previously discussed, management has only 3 choices to consider when the achievable sales growth rate is constrained by inadequate financing. First, improvements in operating performance. Second, changes in financial policy, that is debt and payout. Third, sale of part ownership through equity fundraising. Of course, the venture should also consider moderating the projected growth rate. For Game Toy, there are no known paths to reliable performance improvement. Profit retention is at 100% already. Sufficient debt is not available. That leaves only 2 choices. Either you sell ownership or you change the business model or plan trajectory to one of slower growth. The former involves negotiating with venture investors and potential loss of control. The latter involves organic changes in the firm's strategy, approach, and market penetration. Just as in other situations when a balance sheet doesn't balance, that is total assets exceed total liabilities plus equity, the venture must either alter its asset strategy or alter its liabilities and equity strategy. So the entrepreneurial team should contemplate the associated trade-offs carefully. So entrepreneurial team should see, is there any way in which we can increase the operating efficiency of a venture, in which case we can generate more earnings and just plow that back into the business, or we have no option but to dilute our ownership and to sell our equity to get more funding from outside. So this is a major dilemma, and I've seen a lot of very successful startups feel very jittery when they are supposed to let go of their control. And this is especially true for the founder promoter. but this is a choice that you have to make. Now let us look at the impact of different growth rates on the AFN. While 68,000 may not be a substantial gap for some ventures, the AFN usually grows linearly with sales growth rates. For example, consider how Game Toys AFN rises when sales are projected to grow at 50%. So sales would now reach 2.4 million, which is 50% of 1.6 million, an increase of $800,000. If we assume that the other financial relationships remain the same and we substitute 800,000 over here instead of 480,000 that we were doing initially, the AFN rises to $220,000. Okay, so if sales are projected to grow at 50% rather than 30%, just a 20% growth, the AFN rises to 220,000 from 68,000, which is a greater than threefold increase. Figure 9.8 graphs the AFN for Game Toy at sales growth rates ranging from 20% to 60% for the next year. We hold the venture's operating performance and financial policy stable over the entire range of possible sales growth rates. Of course, in actual practice, operating performance and financial policies are unlikely to be the same at very low and very high sales growth rates. An important point is that with no change in asset or liability strategy, the AFN is likely to increase linearly with sales growth rates. For Game Toy, the AFN increases by $76,000 for each 10% increase in sales growth. During rapid sales growth, the venture should be prepared and should be willing to sell ownership in exchange for the AFN implied by the business model or plan. Okay, so first just look at how linearly your AFN is growing with your sales growth rate. So venture should be ready to then sell ownership and get that additional fund. So this is another reason why you find a lot of these startups seeking VC financing, because they know that the kind of funding required to fuel the kind of growth, they would not be able to generate that themselves. Okay. Now let us see how we can estimate the AFN for multiple years. Although we have used 1 year as a projection period for our examples, the length of time for an AFN calculation is arbitrary. You can calculate it for as many years depending on the data. For example, if Game Toy expects sales to grow at 30% per year for each of the next 2 years, we can calculate the total 2-year AFN. All we need to do is plug 2-year changes in sales into equation 9.8. So this is the primary equation. You can just keep plugging different changes. After 2 years of 30% sales growth, the sales will reach 2.704 million. That is 1.6 million into 1.3 into 1.3 for the 2 years. Total 2-year sales will be 4.784 million. That is 2.08 million plus 2.704 million, reflecting a 2-year change in sales of 1.104 million. Okay. Inserting our numbers into these equations, we will now get a fresh AFN of $156,400. So Game Toy needs to raise 156,400 over the next 2 years. Because we have already calculated that the 1-year forward AFN is 68,000, the additional amount that will be raised to support the second year of growth is 88,400. So when you're making your projections and you're showing that year on year we will be needing this kind of financing, this is the background that you'll be presenting for it. Any doubts, any questions so far? Percent of sales projected financial statements. Now, sustainable growth and AFN calculations are useful for understanding how financial measures interact and relate to future financing needs. Ultimately, however, the goal is to create a set of projected financial statements that quantify the venture's view of the future. So the percent of sales forecasting method projects account balances by assuming that most expenses and balance sheet items can be expressed as a percent of sales. So we've already done all this. But now let's look at it all in a combined manner. For example, if a venture's COGS varies proportionately with sales, that is their variable costs as defined earlier, they represent a constant percent of sales. If the COGS sold last year was 60% of sales, it will be forecasted to remain 60% of sales the next year. So we assume this. Similarly, if assets were 66.7% of sales last year, they'll be forecasted to be 66.7% of sales next year. If sales are expected to grow by 30% next year, assets are also forecasted to grow by 30% to sustain the 66.7% of sales next year. In general, if a cost or balance sheet item is expected to remain at the same percentage of sales from year to year, then it will grow at the same rate as sales. So using a constant percent of sales in projections results in constant ratios and is one way to implement a constant ratio forecasting method. Of course, if one keeps the ratios constant for all years, or one keeps the percents of sales constant for all years, the two approaches coincide. So this is a very popular method and very common method to project sales. However, you should be careful that if you're projecting for say 5 years, then not all costs may continue to behave the same. So you have to keep that in mind also. But for sake of simplicity, we assume that it will be a constant ratio. So the financial forecasting process which is used is to first forecast sales, then project the income statements based on the sales, then project the balance sheet by adding the net profit coming from income, then project the statement of cash flows. Okay, so we all know this. Let us look at it with the example of game toy. First, we start with forecasting sales. We start the financial forecasting process by first forecasting sales because this is the top line projection and sales forecasts drive the preparation of projected financial statements. The ability to project sales accurately is crucial to the venture's financial health. We recognize that forecasting early stage ventures, particularly development stage ventures, is inherently more difficult than forecasting more mature firms, naturally because there's no data. Nonetheless, having some idea of the financial future beats complete ignorance. You can't say that I have no idea what would the returns be, I'm still developing the product, because then no one will give you money, particularly when one is negotiating for external financing. To provide a perspective on the potential ramifications of missing projections, the venture can produce projections under a variety of possible sales and expense scenarios and maintain a spreadsheet version that automatically revises the entire set of financials as things change. We prepare Game Toys financial statement projections using a projected 30% sales increase from a base of 1.6 million in 2016. Thus, sales are expected to grow by 30% to 2.08 million in 2017, an increase of 480,000 over 2016. While all our projected financial statements use the expected 30% sales growth rate, Game Toy should also consider the financial ramifications of higher and lower growth rates. Now, based on this growth rate, let us look at how we project the income statement. Table 9.1 provides a reasonably detailed income statement for 2016. Sales of 1.6 million lead to $160,000 in net income, which is basically a net profit margin of 10%. Recall that the AFN model holds this net profit margin constant when projecting the next year's net income. This, of course, is an oversimplification and would hold only if all costs were variable and would be expected to vary directly with sales. However, as we have already noted, most firms will have some costs that are fixed or at least semi-variable over a range of sales. The percentage of sales forecasting method and its constant ratio variant attempts to simplify projecting a firm's income statement. Everyone knows that cost structures will not remain constant over time. COGS was 60% of sales, and for 2017 is forecasted to be 60% of sales only. That is, 60% of 2.08 million will be 1.248 million. The cost of goods sold is just to be a variable cost and could equally well have been projected by multiplying the 2016 level of $960,000 by 1.3 to reflect a 30% growth, and you would have got the same result. So you can work either way. Either you can take total sales and a percentage of that, or you can look at base COGS and multiply it with the growth rate. Marketing expenses also are expected to vary with sales because venture is planning to increase its advertising budget and other marketing expenses in proportion to the expected increase in sales. Because marketing expenses were 10% of sales, they are projected to be 10% of the 2017 sales or 208,000. The marketing expenses could also have been projected by multiplying the 2016 amount of 160,000 by 1.3 to get 208,000. General and admin expenses are also considered to be fixed for 2016 and 17 and thus are expected to remain at their current level of $152,000. That is, even though sales are expected to grow rapidly, management does not intend to increase expenditures for existing staff employees and does not plan to expand the size of its present staff. Depreciation expenses were 3% of sales and 10% of plant and equipment in 2016. Okay, so look at this. Or let me look at the other data and then come back over here. If fixed assets are expected to increase with sales, as would be the case if there were no excess production capacity at the end of 2016, depreciation expenses would be expected to increase proportionately with sales. So depreciation is projected to remain at 3% of sales level for 2017. Alternatively, the 48,000 in depreciation could have been multiplied by 1.3 to get the 2017 level of 62,400. Of course, if the venture has excess production capacity and the increase in sales can be supported without an increase in fixed assets, then depreciation expenses would remain constant or fixed at the 48,000 level. So for depreciation, you have to see whether you are utilizing extra capacity or you are still functioning at the old capacity. Okay. It is common to produce a first pass projection omitting any cost of additional financing. Accordingly, in this first estimation projection, the 2016 interest expense of 13,300 carried forward to 2017, and we have not yet determined the amount of additional funds that will be needed, if any, and have not decided how we will be obtaining any needed funds, debt or equity. We are simply projecting the P&L. By applying a 40% tax rate to the estimated earnings before taxes for 2017, we project Game Toys net income to be $237,800, a 2017 net profit margin of 11.4%. The reasons that the net profit margin for this first pass has increased from 10% in 2016 are: A, general and admin expenses are not scaling up with sales. Additional financing costs are ignored. So we are not saying that, oh, we'll have to raise fresh debt, so there'll be extra interest expenses. Recall that the AFN model estimated the increase in retained earnings to be 208,000 or 10% of the forecasted sales of 2.08 million. Our more detailed analysis using projected financial statements shows that the spreading of fixed cost over increased sales actually lowers the actual AFN through an increase in retained earnings. So simply because our general and admin expenses have remained constant, even though our scale has increased, we have been able to increase our profitability. Okay. So here you can see the actual 2016 figure, which is given here, and the forecast basis for 2017 is just at 30% growth. So here we are looking at 1.3 into 2016 sales. So this is it. Then COGS has been 60% of sales. So we have taken the same 0.6 into 2017 sales, that is 1.248 million, which gives us a gross profit of 832,000. Marketing expenses have traditionally remained at 10% of sales. So we take the same 10% of the 2017 sales, we get the marketing expenses. General and admin has been given that they are fixed, so they remain constant at 152,000. Depreciation, because we have increased capacity, has also increased at the same level of 30%, so it has moved from 48,000 to 62,400. EBIT is 409,600. Less interest, that has already been fixed. We have not added any debt or anything, so this is fixed. So we get EBT of 396,300. From this we take out taxes of 40% on EBT, which is 158,500, and it gives us a net income of $237,800. Okay. So the additional retained earnings, assuming that we are retaining all of our net income, is 237,800. Okay. So this is much higher than the retentions we were calculating initially. Okay. Now, after we have projected the income statement, we can now look at projecting the balance sheet. So how do we do that? Table 9.2 shows the first pass at the 2017 balance sheet. The approach taken here coincides with the asset requirements from the AFN model. That is, we need 300,000 more of assets. Initially, we expect that all assets will vary or increase with sales. Recall from the AFN model that the total assets as a percentage of net sales in 2016 was 62.5%. That is your 1 million upon 1.6 million. Notice that by expressing each asset item as a percentage of sales in 2016, the total sums to 62.5%. In this first pass estimation, the existing asset to sales relationship is projected to hold for 2017. So for example, inventories were 20% of sales in 2016 and are estimated to be 20% of sales for 2017 sales. Of course, the change in inventories could just as easily have been projected by multiplying the 2016 level by 1.3. So we'll use the same ratio here as well in your balance sheet. After all asset items are projected for 2017, the total increase in assets is projected to be 300,000. That is 1.3 million minus 1 million for 2017. The same dollar estimate produced by the AFN model. The liabilities and equity side of the balance sheet recognizes spontaneous funding and the retention of earnings. Remember that spontaneously generated funds come from suppliers, that is accounts payable, and employees and the government, that is accrued liabilities. Because these current liability accounts are expected to increase, so first let me give you all the data, then we will come back to the balance sheet. Proportionally with sales, they are projected current percentage of sales and grow at the same rates as sales. So in table 9.2, we project the accounts payables balance at 3% of 2017 sales or 62,400, an increase of 14,400, which is a 30% increase over 2016's 48,000. Similarly, accrued liabilities are projected at 2% of 2.08 million or 41,600, which is a 9,600 increase over 2016. So total spontaneous funding is 24,000 or 5% of the 2017 sales of 2.08 million. Notice that this 24,000 of spontaneously generated funds is also the same amount estimated using the AFN model. So up to now, our projected balance sheet calculations project the necessary increase in assets to support a 30% sales increase and project spontaneously generated funding of 24,000. The second and frequently more important source for financing the necessary asset growth is retained earnings. So for Game Toy, the projected 237,800 increase in retained earnings when added to the venture's existing 800,000 in equity in 2016 brings the total retained earnings to 1.0378 million for 2017. So when we prepare a projected balance sheet, the additional funds needed becomes a plug amount that makes the total liabilities and equity equal to the firm's total asset. Very important. You will have a plug amount where you'll need to balance the liabilities and assets in the balance sheet, and this plug will be the additional funds needed, indicating that you need more financing. We start with the estimated 1.3 million in total assets for 2017 and subtract the projected total current liabilities of 224,000 and the equity of 1.0378 million. The result is a gap of 38,200. This gap becomes the AFN that balances the balance sheet. So let us look at the balance sheet. This is the actual data given for 2016, and for forecasting the basis, we have again taken all of this as a percentage of sales. So cash has been 1% of the 16 sales, so it will be 1% of 2017 sales. So this is the projected cash. Accounts receivables have been 11.5% of sales, so we use the same ratio to forecast accounts receivables. Inventory will also move with the same ratio of 20%, so that will be 416,000. Total current assets will continue to remain at 32.5, which is nothing but these three added together. The net plant and equipment also will be increased by the same ratio. We get total assets of 1.3 million, which is again a 30% growth over assets. So you can use all of these figures just to see that your numbers are accurate. Okay. Accounts payables have been 48,000, which are 3% of sales. So we have the same figure for 2017. Accrued liabilities have been 2%. Okay, so that is 41,600. Bank loan continues to be 120,000. So total current liabilities have now increased to 224,000. The common equity has been 800,000. The fresh equity will be 800,000 plus the net profit that you have made, which is 237,800. So gives a fresh equity of 1.0378 million. And this plug amount of 38,200, which will balance our liabilities and assets, is basically the additional funds required. Okay, so we can calculate AFN from balance sheet projections as well. So this we are trying to just link all of the concepts that you have done separately into one aspect. Okay. Now finally we come to the forecasting of the statement of cash flows. Preparing a projected statement of cash flows serves as a check on the projected income statement and projected balance sheet. Because the cash account was projected to remain at 1% of projected sales, the statement of cash flows is prepared at the end. And always do that. Always prepare your cash flow statement at the end, because you can draw from the income statement and balance sheet, and then making the cash flow statement will become very, very easy. We begin with the cash flows from operations, starting with the net income. We add back non-cash items such as depreciation. After adjustments for incremental investments in receivables and inventories and incremental financing from increases in current liabilities accounts, the resulting surplus cash from operations is $173,000. Expenditures for necessary plant and equipment projected at $206,400 create a projected shortfall of $33,400. Furthermore, because the cash needed to conduct operations is forecasted to increase by $4,800 to $20,800, the total amount of additional financing is $38,200. The statement of cash flows provides a check on the other two financial statements and another way of looking at the projected gap in funding. It is important to note that while we don't recommend it, cash flows can be used as a dynamic statement for estimating future cash needs rather than merely as a check of the income statement and balance sheets. I would also suggest that you don't do that. Please prepare a cash budget, which I will teach you how to prepare in the next class, to project your future cash needs. Please don't use a cash flow statement as a projection statement. Okay. For example, instead of fixing cash as a percentage of next year's estimated sales, a minimum target cash amount might be established with additional funds needed to make sure that the minimum is met. I would advise against this because it becomes very confusing to manage. For example, assume that Game Toys management believes that it needs to maintain a minimum cash balance of $14,000 to cover day-to-day operations. In this case, we would first project the income statement and then the balance sheet minus the two account amounts, that is cash and additional funds needed. The statement of cash flows then would be prepared. We would begin with cash from operations. Then, as before, we would estimate investment requirements in fixed assets. Cash from financing operations for the game toy example would be zero, since no new specific plan has been made. The cash account then would be adjusted to reflect that it could be reduced to its target minimum. The balancing variable, if needed, would be the change in the balance sheet account AFN required to keep the cash account at its target minimum. Following is a summary of the statement of cash flow components. Okay. So here you have the cash flow from operating activities, which is 173,000. We have the cash from long-term investment activities, which is basically an outflow, so indicated by 206,400. We have no net cash coming in from financing activities, so the net cash flow is minus 33,400. We have a beginning cash of 16,000 and we need at least 14,000 minimum cash balance. So when we add all of this up, we actually need 31,400 as the additional funds needed to help us maintain the minimum target cash. The balance sheet would be completed by entering 14,000 in the cash account. Because cash would be reduced by 6,800 from the original target of 20,800, total assets would now be 1.293,200 instead of 1.3. The AFN plug, which then makes the balance sheet balance, would be only 31,400, yielding a change of AFN of 31,400 from the 2016 level of 0.
Excuse me, ma'am.
Yes?
Ma'am, 2 minutes left.
Okay. Thanks, Harshita. So after this, let me just show you the cash flow statement and then we'll come back to the explanations. I would always want you to prepare the cash flow statement like this rather than using the plugs for accounts. Whenever you have to project cash requirements, prepare a cash budget, and that is what we will be doing in the next chapter. So here, as you remember, we first start with operating activities. We start with net income. We add back depreciation. We add increase in accounts receivables. There have been no increase, there's been a decrease, so we subtract that. Any increase in inventories, again, that is not there, so we subtract that. Increase in accounts payables, any kind of liability that has increased, we are going to add that. Increase in accrued liabilities, we again add that because this is giving a source of cash. So net cash from operating activities becomes 173,000. Then we have long-term investment activities, which is basically the increase in fixed assets that we are looking at. This is 206,400 negative. Financing activities, we have nothing. Additional funds that is needed is 38,200. So net cash from financing activities would be 38,200. So the net change in cash has been 4,800. The cash at the beginning of the year was 16,000, and hence the cash at the end of the year will be 20,800, or this will be the closing cash balance. So this entry is basically showing us increase in gross fixed assets, which is a sum of the increase in net plant and equipment and the 2,000 depreciation of 62,400. So we're looking at gross fixed assets over here. So I would like to wrap up the session over here, and in the next class we can continue from here. Very little is left, and then we can begin with the cash budget. Okay, how a startup basically creates its cash budget and how it forecasts its requirement for cash later. Okay, so we'll do that later. Any doubts, any questions? Okay. I can only see 5 people here, but how is it saying 6? Harshita?
Ma'am, it's saying 5 in my
अच्छा
my.
मेरे उसमें 6 बोल रहा है, लेकिन 5 ही लोग दिख रहे हैं, मतलब जिसमें 2 लोग हम लोग हैं.
Yes, ma'am.
ओके, ठीक है. I wish we could have had some attendance policy or something, but because of this online semester, we can't have that because this attendance is totally pathetic. Okay. Okay, so let us wrap up over here and we'll continue with this in the next class. Okay. Thank you so much, Harshita. Thank you,
Thank you,
everyone.
ma'am.
Thank
Good
you,
evening, ma'am.
Ronald. Okay,
Thank you, ma'am.
bye-bye.
Thank you,
Thank
ma'am.
you. Thank you. Bye-bye.